Hello, ladies and gentlemen. I'm Dave Lerman from the CME's Education Department, and today's Trader's Edge installment is going to discuss options on copper futures at the COMEX. Quick disclaimer, neither futures trading nor swaps trading are suitable for all investors, and each involves the risk of loss, so we must do our homework. Few copper fundamentals that we should go over quickly. As China goes, so goes copper. China accounts for 42% of global consumption. It's the third most used metal in the world after aluminum and iron. It's concentrated with 45% of output coming from two countries. Australia is the third largest producer after Chile and Peru. Freeport-McMoRan Copper and Gold, Rio Tinto, BHP Billiton are the three largest producers of copper in the world. They're all publicly traded. China, the U.S., and Germany account for 42%, 28%, and 6% of copper consumption, respectively. We'll skip the next bullet point and just get to the last one. Dr. Copper. Copper is frequently referred to as Dr. Copper because it's an indicator of the global health, the health of the global economy. As economies turn around and prosper, more copper is used. It's used in construction, it's used in autos, it's used in appliances, it's used in electronics, obviously. Dr. Copper should provide trading opportunities in options for sure. And it's also a lot of people regard it as an interesting reopening trade as global economies continue to reopen and vaccination becomes more and more widespread. So again, getting back to the China theme here for a little bit, you can see copper and you can see the prices correlate very well with Chinese economic growth. Instead of GDP, there's the Li Keqiang index of China, and you can see as copper, as the economy goes down, copper prices tend to suffer. As the economy does well, copper prices advance. So very interesting correlation there between Chinese economic growth and copper, given that they take in 42% of the world's copper. Here's the long-term price going back about 20 years, and you can see copper topped out back in after the financial crisis of about $4.50 a pound. It hit a pandemic low of just above $2 a pound, and now we're at $3.90. So there's been tremendous opportunities for traders, whether you're a futures trader or an options trader. There's been a lot of movement over the last 20 years as economic cycles ebb and flow. The next chart just goes back 1 year. It's a chart that goes back to the pandemic. You can see in March of 2020, you can see a steady uphill climb from about roughly just a little bit over $2 a pound to where we're at now, $3.90. And again, a very nice steady upward movement. Also accompanying this upward movement, even though we've nearly, we're up about 90% in price, volatility has been, within a pretty tight range between, 20 and 26% basically. That pandemic spike was way up there. Volatility still running high for copper, but it's made a nice little channel there. It's range bound for the most part, but it's still running relatively high, and we have to take that into account whenever you do any kind of options strategy, whether it be copper or any of the metals. So here's a chart of the at-the-money implied volatility. It goes back quite a bit further than the last one that we have, but you can see the pandemic spike up to around 50%. And since then, we've been trading basically, we haven't gone below 20% for about a year now, except for a couple of brief moments. But we're between 22 and 27%. We've been range bound, despite the fact that copper's up almost 90%. So instead of looking at a chart, we can look at volatility percentile rankings and see the impact on copper options. You can see the highest volatility in the last 3 years, 49%. The 90th percentile, which means 90% of the time volatility is lower. And when volatility goes lower, that has an adverse impact on long options prices. So the 90th percentile is 24.51, which is about where we're trading at now. So we're at a high volatility, but this volatility has been, steady. It's been very steady for the last, 8 or 9 months, despite copper's major rally. So I also have in the third and fourth column, you can see the at-the-money straddle in points and in US dollars. And you can see the impact on volatility. At the high, look at how much you would have paid for an at-the-money straddle, 10,738. Just in the 90th percentile, 10 percentage percentile levels lower, you'd only pay $5,365. So if you don't think volatility has an important impact on your strategy, think again. Down in the 50th percentile, the straddle would only cost $4,190. So pay attention to volatility. But there's other things you need to pay attention to, like bid offer spread and block trades and liquidity in general, and that's what we're going to talk about now. So this comes from CME Direct. It's just a print screen. And we have the red rectangle there, and you can see all the calls along the strike prices: 383, 384. The 389 is the one that's circled with red or with a rectangle, and it has the puts and the calls, and then it has the size. So you can see the 389 calls. They're 1650 by 1690, 18 by 18. So there's 18 contracts on the bid side, 18 contracts on the offer, and it's 0.1650, 0.1690. So very competitive bid offer spreads. We also have the bid offer spread in volatility terms, and you also can see it on the put side. It's 33 by 25, 1650 by 1695. So very competitive markets, and that's important. Bid offer spreads need to be competitive because doesn't matter how low your transaction costs are, bid offer spreads are wide, that just adversely affects your ability to have profits. So you want competitive markets, good markets, all the way along different strike prices so you can do various combinations. However, of late, copper options trading conditions have become more conducive, okay? Since copper's taken the limelight once again because of the reopening trade and China's economy turning around and all other economies around the world starting to slowly reopen, the conditions for trading copper are good. So bid-ask spreads on the screen are very competitive. We've mentioned that. Large block trades are being executed with regularity, and some are as large as 1,000 contracts or larger, either as an outright or a spread or a combination trade. So check that out. RFQs, or requests for quotes, are also available, and they help eliminate leg risk in trades such as delta neutral strategies. Size delta neutral trades have been executed as a result of the RFQ functionality. So if you're doing some kind of vertical spread and want to hedge it against the futures contract, you could do that using the RFQ function, and you can do it in size, 550 contracts, 100 contracts. We've seen some RFQs go across for 200 to 300 contracts. And as we said, implied volatility has been pretty stable range, even as copper rallied from 2 to 389 since the pandemic low. So that's interesting, and it's good. So it's still running high, but it's been very, very stable. So be careful and just monitor the volatility and align it with your strategy, because if you trade the wrong strategy in the wrong volatility environment, it will lead to suboptimal results. So good trading to everyone, and I invite you all to visit cmegroup.com/education for further your learning curve on copper futures and options on copper futures. So thank you for listening.